Hello, this is Bennett Tchaikovsky, and welcome to a comprehensive adjusting journal entry question. This presentation is copyright 2018 to 2019 by Bennett Tchaikovsky. All rights are reserved. The opinions expressed herein are those of the author only and not the South Orange County Community College District, Irvine Valley College, or any other place where I may be employed in the future. So hello again. And so this is a sample question that I typically will give to my intermediate accounting students to make sure that they have the basics of financial accounting understood. So let's go ahead and get right into it. So the way the problem is laid out, I made a slight change to the name to avoid any type of infringement lawsuit. So there you go. And so we have here a unadjusted trial balance. And remember, the trial balances are not in fact financial statements. They're really here to help us make sure that our total debits equal our total credits, so that when we go through and basically perform our financial statements, we know we're balancing. This is a different type of question because in this question, in my earlier financial accounting videos, when I'll do a adjusting journal entry problem, I'll have the students go through initially and record the raw transactions. They summarize those into an unadjusted trial balance. I will then tell them what transactions need adjustment, and then I will go through and then have them make an adjusted trial balance and the like. This is a little bit different. In this case, an unadjusted trial balance has already been made for us. It may not necessarily be correct. However, it's been made for us. And so what we're going to go through and do here is we're going to basically take this information and then make the adjustments. So we're asked to do a few different things. The first one is we're going to be asked to prepare adjusting journal entries. We're going to post those adjusting entries into the T accounts. We're going to create an adjusted trial balance. And then we're going to do an income statement and a statement of retained earnings for the year ended December 31st, 2019, assuming that our beginning retained earnings were zero. We're going to close out all temporary accounts to retained earnings, and then we're going to prepare a post-closing trial balance. And lastly, we're going to be preparing a classified balance sheet as of December 31st, 2019. So the first step we're going to do right here is I have the T accounts in here. So the first thing we're going to do is we're going to put in our opening balances. And so what I want you to do is that if you're at home or hopefully you have a copy of my sheet. So what I'm going to do here is put in these initial amounts. Okay, so here the cash was 280,000 debit. So all I'm doing is going over here, putting cash as a 280,000 debit. My office supplies were $3,000. My equipment was $130,000. My accounts payable was a $10,000 credit. My loans payable was a $100,000 credit. Common stock at par was $1. Additional paid in capital common stock was $199,999. Again, I'm getting these right from over here. So I'm just pulling these off of this unadjusted trial balance and just putting these balances into T accounts. My dividends were $30,000. My services revenue were $240,000. And then I get down here to my insurance expense at $48,000. And then we get over here, utilities expense is $35,000 and rent expense is $24,000. So all I've done here is I've gone through and I've done what I would call the basic setup, which happens to be extremely important. If you don't do this correctly, when it comes to actually going through and doing the problem later on, you're going to be wondering why you didn't balance. It's critical for you when you're doing accounting to go through and make sure that you're, writing this out. Absolutely critical. Just make sure I do this right. Debits to insurance expense, utilities and rent, 48, 35, and 24. Services revenue right here of 240. So I've gone through and I've transferred all these over here to the various different T accounts. Okay, so now that I've done that, okay, now what I'm ready to go through and do is to deal with the additional information. So the first thing it tells me is it says that services revenue was recorded by RHI on June 1st, 2019. This related to an upfront payment from Vegas. RHI is to perform the services on a monthly basis beginning on June 1st, 2019 through May 31st, 2020. The service obligation is estimated to be the same for each month by RHI. So I'm looking at this $240,000, and when I show here in terms of if I'm recording revenue, this needs to represent revenue that I earned during the period of time that I'm looking at. And in this case, it's from January 1st, 2019, and I'm being asked to do an income statement for the year ended December 31st, 2019. So when I look at the services revenue of $240,000, this can stay here as long as that represents how much money I earned during the year December 31st, 2019. So what I'm going to do is I'm going to bring these T accounts over here to our main page so we can kind of work through this right over here. Okay. So we have services revenue was recorded of $240,000. So the question we want to ask ourselves, is this the correct amount of revenue we should be recognizing for the year ended December 31st, 2019? So as I look at this here, as it says, related to an upfront payment, okay, and we're to perform the services on a monthly basis beginning on June 1st, 2019 through May 31st, 2020. So we have a slight issue here. We should not have recorded this as services revenue because we've only been doing the work since June 1st and we just did it through December 31st. We're not in the future yet as of May 31st, 2020. So what this number right here needs to represent is how much work did we perform from June 1st, 2019 through December 31st, 2019. Okay, so we received an upfront payment from Vegas Inc., and this is for $240,000. And when we look at this upfront payment that we received, it was for how many months? Well, it tells us right here that it was basically for June, July, August, September, October, November, December, January, February, March, April, May. It was essentially done for 12 months. So right here, the amount of monthly revenue that I should be recognizing, so this is 6/1/19 through 5/30/20 or 5/31/20. So this is a period of 12 months. So the amount of monthly revenue I should be recognizing from this contract is going to be $20,000 per month. Okay. So right over here, I know that for the year ended December 31st, 2019, how much should I be recognizing in terms of revenue? It's not going to be $240,000 because I haven't performed 12 months worth of service. Rather, what I should do is to say, okay, how many months worth of work did I do in 2019? What I need you to do is to hold up your hands, and I want you to count out the months for me. June, July, August, September, October, November, December. So it's going to be 7 months. So 2019 revenue should be 7 months, or 6/1/19 through 12/31/19 times 20,000, or $140,000. Now, as you notice right here, if we put in $140,000, we have a problem. The true amount of services revenue should be $140,000. However, it has over here a $240,000 credit balance. So what do we need to do to get from 240 to 140? Well, we need a debit here of $100,000. So over here, I'm going to debit services revenue for $120,000. And when I debit services revenue for $100,000, what do I need to credit? So if you've watched any of my other previous videos, what you'll kind of go through and see when it comes to adjusting entries, when it relates to revenues, is what you're going to be using is an account called unearned revenue, which is a liability. Okay, so right over here, I have this unearned revenue, which is going to be a liability. Now, when we look at unearned revenue, so we know that our services revenue is correct, but when I look at unearned revenue, is this correct? What is unearned revenue? Unearned revenue is a liability which represents the future amount of services that we have to perform. So our future services that we have to perform in this instance is going to be from January 1st, 2020 through May 31st, 2020 for a total of 5 months. And when I multiply that by $20,000 per month, I'm going to get $100,000, which is going to be the amount of unearned revenue I should have on my financial statements as of December 31st, 2019. This problem best illustrates the most important concept as it relates to adjusting journal entries. When you're done going through and adjusting, your revenue needs, or part of it, your revenue needs to reflect what did you earn during the time period, and your liabilities need to reflect your future obligations. And if you didn't know whether or not to use unearned revenue, I would suggest going back and taking a look at some of my adjusting journal entry videos where I specifically go over this topic and how unearned revenue is adjusted. Now, some of you also might be saying, hey, Tchaikovsky, they should have booked this to unearned revenue initially, but they didn't. They screwed up. People make mistakes. And so what we have to do is we have to adjust the balance to the proper amount. And so the way I'm going to go through and do this is I'm going to by making a debit here to services revenue, I'm going to end up with my correct amount of services revenue of $140,000. And my credit is going to be to unearned revenue, or $100,000. Very important, when we are doing adjusting journal entries, we never, ever, ever touch cash. You don't do it. You do not mess around with cash. That's not Johnny Cash, but it's the true. Well, probably him too. But it's the true cash. You do not touch cash when we're making adjusting journal entries. Okay, so that's just part one right here. So what I'm going to go ahead and do is I'm going to go ahead and make that entry right here into my accounts. And I'm just going to put the transaction number down by each one right here. And the reason why is because if I need to go back and look to see if I've done something incorrectly, I can go back and see that a little bit later. Okay, so my ending balance here in unearned revenue is $100,000, so I'm done with that particular transaction. Okay, number two, insurance expense was recorded on May 1st, 2019. The policy is for 2 years, beginning on May 1st, 2019, and lasting through April 30th, 2021. So what I'm going to do is I'm going to pull up here the accounts that will relate to that particular transaction, mainly insurance expense, and the other one being my prepaid insurance. And we'll show you how that kind of interacts here in a second. Okay, and let's just move this down a little bit more. Thank you for bearing with me, and I really should be pausing this. I'll do that next time, I promise. Okay, so now we're getting over here to prepaid insurance and insurance expense. So the company bought an insurance policy, and instead of debiting prepaid insurance, which is what they should have done, is that they said, well, we're just going to go ahead and debit insurance expense. Okay. So when we look at this question right here, is that this over here related to a policy which is for 2 years. Okay, so it begins on May 1st, 2019, and it went through April 30th of 2021. So the way we have to go through and treat this is we have to kind of say to ourselves, well, does this represent the amount of insurance expense from May 1st, 2019 through December 31st, 2019. This has to be the amount of expense that is reflected here. The thing is, though, this $48,000 is giving us 2 years of benefit. So there's no way that this number here could be $48,000. So what I need to figure out is that how much insurance expense should I have recognized for the 12 months ended May 1st, 2019. So the way I'm going to do that is I'm going to say right over here is I'm going to say, okay, my total policy amount, which is going to be here, or $48,000, divided by the months of coverage, which here is going to be 24. And how did I get 24? This is going to be May 1st, 2019 through April 30th, 2021. So right here, the amount of insurance expense that I should be recognizing each month needs to be $2,000 each month. So what I'm going to do here is I'm going to say, okay, how much insurance expense should I have recognized? So I'd like you to hold up your hands again, and I want you to count it out. May, June, July, August, September, October, November, December, 8 months. So the amount of insurance expense that should be recognized here is going to be 8 months times $2,000 per month, or a total of $16,000. So if I put $16,000 here, right, what I'm realizing that I need to do is, well, $48,000 does not equal $16,000. So what I need to do is I need to make an adjustment. So 48,000 minus what equals 16,000. X is going to be equal to 32,000. Okay, and if you're having trouble with this, go through and look at some of my earlier videos that describe how to go through and calculate T-balances. So I need to credit insurance expense for the amount of 32,000. And when I credit insurance expense over here for the amount of $32,000, what account do I need to debit? So the account I'm going to need to debit is going to be prepaid insurance. Prepaid insurance is an asset, and it represents the future economic benefit we are receiving from an insurance policy. And this kind of makes sense because as of 12/31/19, we have how many more months of insurance coverage? Well, as it turns out, we have 16 months of coverage, or 1/1/20 through 4/30/21, which is 16 months. So the way we're going to check our work here to make sure we've done this correctly, because remember, our expenses need to reflect what we use during the period, and our assets need to reflect the future economic benefit. So right over here, what you're going to be doing is you're going to be saying, okay, I'm going to have 16,000 times $2,000 times 16 months. So my prepaid insurance balance as of 12/31/19 is going to be $32,000. So I know that that is in fact correct. So again, this is how I'm going through to make sure that I've done my work properly. So I'm going to go ahead over here. I'm going to go ahead and credit insurance expense for $32,000. And then over here with prepaid insurance, where did I put prepaid insurance? Uh-oh, hold on. So here I'm debiting, I'm crediting insurance expense for $32,000, and this should just be without a dollar. So I'm debiting, I'm crediting insurance expense, and then I'm going to be debiting prepaid insurance right over here for $32,000. Okay, so I know some of you might be saying, hey, Tchaikovsky, I thought with your rule of accounting, and my rule of accounting is like this, which is like, okay, I've got assets equals my liabilities plus owner's equity. Okay, debit, credit, expense, revenue. I know that some of you are saying, hey, Tchaikovsky, why are you crediting an expense? Well, the answer is I'm the moron that basically went here and debited it for initially to mess with you guys. And so you need to basically reduce it. What some people might do is they might do a reversing entry and then they might do these other things, but you know, I'm not doing that. So there you go. Okay, we're getting to the correct balance. Remember, the ending expense balance needs to reflect what you used during the period, and my assets need to reflect my future economic benefit. Okay, so now we're getting over here to an equipment question. So I'm just going to pause really quickly while I pull up these TA accounts magically. Okay. The equipment here that was purchased on August 1st, 2019. The equipment has a 10-year life at $10,000 salvage value and will be depreciated on a straight line basis. So when I see something like this, what I need to go through and do is to essentially go through and show the use of that asset. When I buy an asset such as equipment, I have to depreciate it or show the use of that equipment over time. And so straight line depreciation is going to be this equation right here. It's going to be my acquisition cost minus the salvage value divided by the estimated useful life. So here my acquisition cost is $130,000. My salvage value is $10,000 because the problem is telling me right here. And I'm dividing this right here, $10,000 salvage value. I'm dividing this over here by 10 years. So my annual depreciation expense is going to be $12,000 per year, or $120,000 divided by 10, or $12,000 per year is going to be the annual depreciation expense. Now, the challenge I have with this here is that I bought the equipment on August 1st, 2019. So therefore, what I need to do is to make sure that, well, if this is the annual amount of the depreciation expense, what is it going to be for 2019? Because again, I bought it on August 1st. I did not buy it on January 1st. So what I need to do is I need to say to myself here, it's like, okay, August, September, October, November, December. Again, we're going to count this out on our hands. So right here, so the use in 2019 is going to be 5 months, or August 1st, 19 through 12/31/19. So what I'm going to do right here is if it's $12,000 annual, if I divide this by 12, it's going to be $1,000 depreciation expense per month. So what I'm going to get over here is I'm going to have 5 months times $1,000 gives you $5,000 depreciation expense for 2019. Now, alternatively, what I could have also done too, another way, again, how else could you have done this? Well, it's 12,000 annual depreciation times 5/12. This is also going to give me $5,000. Same answer. Okay. The important thing is, at least when you're taking my exams, you want to make sure that you're showing your work. So make sure that you show your work. When I depreciate an asset, no matter what method that I use, I always use the same type of entry. And so the entry that I'm going to be using over here is basically going to be, so if I take over here, okay, I debit depreciation expense because that's how I go through and record expenses. Okay, so that thing we were looking at down here before, where did that go? Right over here. I record my expenses with debits. What I'm crediting over here is accumulated depreciation on that equipment. Now, what exactly is accumulated depreciation on the equipment? It is called a contra asset account. It is going to reduce the carrying value of the asset. What does contra asset mean? Well, if I looked on the balance sheet a little bit later on, I would see equipment valued at $130,000 less accumulated depreciation on that equipment. Okay, negative 5,000 would be giving the equipment .net, basic equipment net. Almost made it a .com. So right over here, accumulated depreciation on equipment is a contra asset account. And when we do the balance sheet, this is what we're going to be seeing a little bit later. Okay, so that is number 3. So let's go through and put this in right over here. Okay, so we're now going to go down to the next one. Is I performed $30,000 of services for Olabi Inc. on December 31st, 2019. However, I did not send Olabi Inc. an invoice for services as of December 31st, 2019. So what exactly is this? If I've performed services for somebody, even if I have not billed them, I need to recognize the revenue. So let's pause real quick and I'll pull up the relevant accounts. Okay, so I performed services for somebody, but I have not been paid. It doesn't matter whether I've invoiced somebody, just haven't paid. What exactly is invoicing? And I'm going to take a quick break here, show something, and I'll get right back to you. So an invoice is a way a company has of sending over a document stating pay me. And it really means that you've performed the services or you're billing the client. Hopefully, I mean, I actually maybe be putting this out before you actually perform the services, which is smart. But what you're going to do is once you've performed services or you've entered into a contract, it's essentially a way of telling the client to pay you. A lot of clients will not pay you unless they have an invoice. Also, too, some clients may require a purchase order or a PO. Is that the same as BO or body odor? No, it is not. It is a purchase order, which means that your client is approving your services in advance to actually going through and receiving them. So that is what is known as an invoice. So when it comes to recording revenue, it doesn't really matter if I have not sent out an invoice. What does matter is how have I actually performed the services. If I've performed the services under the contract, then I am owed payment. So it doesn't matter in terms of recording revenue whether or not I've billed the client. So when it comes to recording revenue, I'm just going to go over here and credit revenue, consulting services revenue. And what I'm going to do here is, because I'm not going through and actually receiving any cash, this company that I've performed the services for actually owes me the money. So what I'm going to do is I'm going to be debiting accounts receivable. Now, could you have gone through and used this other revenue account up here? Absolutely, yes. I'm just using this one separately just for additional clarity. So For number 4, I'm going to be crediting consulting services revenue, and then I'm going to be debiting accounts receivable here for $30,000. Does this make sense? Well, right over here, accounts receivable is an asset. It's giving me future economic benefit in the fact that the client owes me money and it's going to eventually convert to cash. I record increases to my assets with debits. Accounts receivable should have a debit over here. Consulting services revenue, I record my revenues with credits. So come over here, this is number 4. Let's go ahead and take a look at number 5. So right over here for number 5, we have Colossus Breakfast Inc. Performed consulting services for RHI in the amount of $20,000 in 2019. However, they did not send us an invoice as of 12/31/19, and we had not recorded the transaction on our books. So this is the opposite of above. Okay, so right up here, Colossus Breakfast is performing services for us. Okay, so we're receiving the benefit of those services. Even though we have not paid for those services, we still need to record the expense. So let's take a look at that one real quick. So the 2 accounts we're going to use to go through and show this is going to be consulting services expense and accounts payable. You could also technically use accrued liabilities. I'm just using accounts payable. If we notice right here, accounts payable have this $10,000 credit. Where did this come from? Well, when we got our unadjusted trial balance, there was already a balance in here of $10,000. So that's where that came from. So right over here for number 5, they performed services for us in the amount of $20,000. However, we had not paid that and we had not been sent an invoice, so it's not on our books. So right over here, the way I record expenses is generally going to be with a debit. So I'm going to debit consulting services expense. And what's my credit going to be? Well, I'm not paying cash for these services. Rather, I'm going to be crediting accounts payable because it's an amount that I still need to go through and pay. So I'm debiting consulting services expense. I'm crediting accounts payable. So right over here, transaction 5, debit consulting services expense. And then I'm going to go over here to accounts payable and credit this over here for $20,000. Okay. So we're now ready to move on over here with transaction number 6. It says right over here, the loan payable relates to a loan that was obtained by RHI on October 1st, 2019. The loan bears interest at 6% per year. Principal and interest are due on September 30th, 2021. So for this transaction right here, and again, I would refer you to my earlier videos that talk about different types of adjusting journal entries. The one thing we're going to be doing right over here is when we've borrowed money, the journal entry to adjust for the interest is always going to be the same. So what I'm going to be doing over here is I'm going to be going ahead and I would be debiting interest expense, and I would be crediting interest payable. Okay, so the amount of the loan is, let's figure this out, right over here. The amount of my loan is $100,000. Okay, so if my loan amount is $100,000 and it's bearing 6% per year, the amount of the annual interest is going to be a $100,000 loan times 6% interest per year, or $6,000 per year in interest. However, similar to the other problems, okay, or the other questions, we borrowed the money on October 1st. So this $6,000 would be for a full year. However, for us, and again, we're going to count this on our fingers, October, November, December, we need to take $6,000 annual interest times 3/12, or we're going to get $1,500. Okay. The other way we could have done this is we could have also said, well, $6,000 divided by 12 months is equal to $500 per month. If I then take 500 per month times 3 months, I'm going to get 1,500. Okay, so that's how we compute the interest expense. The way I'm going to do this over here is I'm going to debit interest expense for 1,500, and I'm going to credit interest payable for 1,500. Okay, so I've done this over here for number 6. And now what I'm going to go back over here and do, we're going to go ahead and put this into the T accounts. Okay. The next thing I'm going to go through and do is it says over here, account of the office supplies revealed that $1,500 was on hand as of December 31st, 2019. So what do I need to do here? Well, let's take a look at office supplies. So for my office supplies right here, it tells me that, well, you started out with 3,000 and then we ended up with $1,500 because this is what the count revealed. We only had $1,500. Our office supply is an asset and it's yes until our employees take them. So right over here, we have somewhat of an issue. So what we need to figure out here is to say, okay, our office supplies were basically 3,000. We're now down to 1,500. So what do we need to do to adjust office supplies? Well, we're going to need a credit of 1,500 because if I credit office supplies for 1,500, I subtract the smaller from the larger value, I end up with $1,500. But for every credit, I need a debit. And so what I'm going to do here is I'm going to be debiting office supplies expense for $1,500. And that's how I'm going to do my adjusting journal entry for number 7. So let's go over here. So let's see, we've got office supplies here. We're going to say here 1,500. This is going to be transaction 7. And then I'm going to be debiting office supplies expense, which is nowhere to be found. Great job, Tchaikovsky. Just give me a moment here. I'm going to pause you. Okay, and so I debited over here office supplies expense, which again is coming from this part. So I've gone through and I've made all of these various different adjusting entries. Now, the other thing I may be required to do is I may require you to actually make the journal entries on your exam. The reason why I start with T accounts, because if I do the T accounts, the journal entries are much more simple. So just pause real quick and I'm going to show you how to make journal entries from T accounts. Okay, we're back. So let's go ahead and we'll do a few of these. I'm not going to do all of them because I think once you kind of see how these work, they kind of make sense. So let's do for a transaction 1, we'll do a reference, say like number 1. Okay, so right over here, my reference is 1, meaning transaction 1. When I'm doing an adjusting journal entry, I'm always going to be using the period end date, which happens to be here, December 31st, 2019. I'm going to go ahead in here. I'm going to be showing, this is what was my transaction. So I debited services revenue and I credited unearned revenue. Notice here, and this is something that students miss constantly, so I'm always pointing this out, you have to indent the account description. Very, very important, because when you're showing your debit over here, it's over here on the left, and the credits are going to be on the right-hand side. So right over here, because this credit is indented, meaning it's over here to the right-hand side, when I'm doing the account description, it also has to be on the right-hand side. So right over here, this is going to be to adjust. So this here will be to properly adjust for services revenue. Okay, so what I can literally do is I can go through here and I can make all of these various different journal entries. I generally don't. I'd rather kind of do things in T accounts. However, I do understand that some employers want you to go through and to do this. So here, what this would be for the second transaction would be, oh, I'm going to be debiting insurance expense. Excuse me. I'm going to be debiting prepaid insurance for $32,000. And then I'm going to be crediting insurance expense for the $32,000. And then here would be to adjust prepaid to adjust insurance expense. So something like that. I'm not a huge believer in the descriptions. Generally, whatever your supervisor or whatever firm you're working for tells you how to write the description when you're doing an adjustment is fine. And again, you can kind of get it. I'll do one more. So over here, so reference number here is 3. The account here that I'm going to be, I generally like to put my debits first and then my credits. So here I've got depreciation expense for $5,000. And because this is a credit, I'm going to be crediting accumulated depreciation on the equipment. And this is here is to record depreciation expense. Okay. So that's how I go through and I do journal entries. As you can see, if you do the T accounts and you write the adjustments in the T accounts, the journal entries become relatively simplistic to do. Okay, so now I've gone over here and I've gone through and I've made my adjustments. So I've adjusted, I've went through number 1 through 7, and I've made all of these various adjustments over here to this account. So what I'm going to do now is I'm going to total up all of the T accounts, and then I'm going to create an adjusted trial balance. And then we're going to take a pause because this video is getting way too long. So how do I go through and make my adjustments? Well, or how do I create an adjusted trial balance? My cash balance has a balance here of $280,000. My office supplies have an ending balance. We saw this earlier, $1,500. My equipment has an ending balance of $130. My accounts payable has an ending balance of $30. My loans payable is at $100,000. Common stock par and additional paid in capital common stock have not changed. My services revenue is still $140. My unearned revenue is $100. My insurance expense is $16,000. My utilities expense, my rent expense, and my prepaid insurance are all here from those prior adjustments that I was making. My depreciation expense is $5,000. My accumulated depreciation on the equipment is $5,000. My consulting services revenue from that second job is $30,000. My accounts receivable is $30,000. Consulting services expense is $20,000. Interest expense is $1,500. Interest payable is $1,500. And my office supplies expense are $1,500. So now what I'm going to go here and do is I'm going to go ahead and take all of these new accounts that I went through and created and go through and create essentially this adjusted trial balance. So I'm going to go ahead and pause, and I'm going to put the numbers from here, the ending balances in here, into this and make sure that it goes through what I'm going to go through and do is I'm going to go through and post all of these adjustments that we just totaled up, those final balances. I'm going to put them in here into the adjusted trial balance account. I'm going to go ahead and pause as to not make this video longer, and then I'll be back with you in a moment. Okay. So what I've gone through and done here is I've essentially updated this trial balance for all the adjustments that we've made. And as you can see here, it miraculously equals $606,500, which I hope is correct. A couple different things I'm going to mention about doing trial balances. The way you want to do it, in my opinion, assets, liability, equity. Notice here I put in retained earnings as a 0 beginning balance amount, as it told us here in the problem that it said right over here. assuming beginning retained earnings was 0. And if you notice right here, so beginning retained earnings, I have dividends, revenues, and expenses. The reason why I set this up like this is because when I look at these values here, if I set this up right, this is going to be my income statement. Then over here, when I include dividends and I'm going to get to retained earnings, this is going to then give me my statement of retained earnings. What I'm going to have to do after I do this is I'm going to have to close out all of these temporary accounts. And what is a temporary account? Revenues and expenses are what we earned or what we use in the course of those earnings, as well as dividends or, basically giving back to our shareholders. Those are all temporary accounts that will have to be closed out to retained earnings. The only other thing I didn't do, which I could go back through and do as I'm going through and doing this, is I could have done a little bit of a better job in terms of segregating my liabilities between current and non-current and my assets between current and non-current. So that's the only thing I could have done maybe a little bit differently. But other than that, this is really a trial balance is not a part of the financial statements. When you look at the financial statements for any publicly traded company, you're going to find an income statement, statement of owner's equity, balance sheet, statement of cash flows, which we're not covering in this exercise. But as you go through and you do that, the trial balance is really here just to make sure, okay, we made these adjustments. Do our total debits still equal our total credits? So that's really why we're going through and doing this. Okay, I'm gonna stop this video here because it's gone way too long, but I'm gonna go ahead and we'll pick this up. So this is going through preparing the, for this one particular problem, for doing all the adjusting entries, preparing the adjusted trial balance. Our next video is gonna focus on the financial statements and then closing out those temporary accounts to retain earnings and then doing a balance sheet. Have a great one. Don't forget to like and subscribe, and I'll see you on the next video.